69%. That is how much of the Korean stock market is trading below book value right now. Below book value means the market thinks these companies are worth less than the value of their physical assets. Imagine someone telling you that your house, your car, and your savings are collectively worth less than what you paid for them. That is the situation for almost 7 out of 10 Korean-listed companies. It is called the Korea discount, and it is one of the most persistent valuation anomalies in global finance. But in 2026, something is finally changing. I'm Alex.
And I'm Maya. Welcome back to Asia Tech Macro. Okay, Alex, Korea is fascinating because on paper, it should be one of the best markets in the world. Samsung, SK Hynix, Hyundai, LG, Naver, Kakao, K-pop, K-drama. Korea has globally dominant companies in semiconductors, consumer electronics, automotive, and entertainment. So why does the market trade like a discount store?
The Korea discount has been one of the most studied puzzles in Asian finance, and it boils down to one word: chaebols. Korea's economy is dominated by family-controlled conglomerates, Samsung Group, SK Group, Hyundai Group, LG Group, that prioritize family control, cross-shareholdings, and empire building over shareholder returns. For decades, Korean companies hoarded cash, issued shares at below-market prices to family entities, and treated minority shareholders as an afterthought. The result is that global investors apply a structural discount to Korean stocks because they do not trust that they will see fair returns.
But you said something is changing in 2026. What is different now?
The Corporate Value Up program. Inspired by Japan's hugely successful corporate governance reforms, the Korean government launched a formal initiative to address the Korea discount, and in 2026, it is expanding significantly. Starting this year, all KOSPI-listed companies are mandated to disclose whether they have a value enhancement plan. Companies with over 500 billion won in market cap are required to announce their plans publicly. It is essentially the government saying, either tell shareholders how you are going to improve returns or explain why you are not.
That sounds a lot like what Japan did with the Tokyo Stock Exchange reforms that we discussed in a previous episode. The TSE told companies trading below book value to fix it or face consequences, and that worked spectacularly.
It is directly modeled on the Japanese approach, and the question is whether Korea can replicate Japan's success. The early results are mixed but promising. A Korea Value Up Index was created with strict selection criteria: profitability, consistent dividends or buybacks, price-to-book ratio in the top 50%, and high return on equity. 67 KOSPI companies and 33 KOSDAQ companies made the cut. Aberdeen published an analysis asking, will Korea's Value Up program be a game changer? Wellington Management and East Capital have both highlighted the program as a potential catalyst for re-rating Korean equities.
But there is a backdrop of political chaos to this story, right? Because Korea has been through an incredible political crisis recently.
Incredible is an understatement. In December 2024, President Yoon Suk-yeol declared martial law, which lasted only a few hours before being reversed, but it triggered a political firestorm. Yoon was impeached in April 2025. The economy actually contracted in Q1 2025 as consumer and business confidence collapsed. GDP growth for all of 2025 came in at just 1%.
1% growth for the world's 13th largest economy is terrible. How has the recovery looked?
The recovery has been surprisingly resilient. The Bank of Korea projects 2% GDP growth for 2026, driven by brisk exports and recovering private consumption. The OECD is slightly more optimistic at 2.1%. Two supplementary budgets in 2025, combined with rate cuts from the Bank of Korea, provided fiscal and monetary support. Consumer confidence has rebounded. Real wages are rising. But the won remains weak at around 1,470 to the dollar, which creates both opportunities and challenges.
And the weak won is not entirely bad news, right? For exporters, a weak currency is a competitive advantage. Samsung and SK Hynix overseas earnings translate into more won. K-content production costs become cheaper in dollar terms, making Korea an even more attractive production hub for Netflix and other streamers.
Exactly, and that is the Korean paradox in a nutshell. The weak won that depresses investor returns in dollar terms simultaneously boosts the competitiveness of the very companies investors want to own. It's the same paradox we discussed with Japan's yen. The difference is that Korea's stock market has an additional layer of discount from governance issues that Japan has already addressed. Korea is basically Japan 3 years ago, but with more structural headwinds and more potential upside if the reforms actually work.
And there is a geopolitical overlay here too. Korea sits between China, Japan, and North Korea. The proximity to North Korea creates a permanent risk premium that Japan does not have. And US-China tensions put Korea in a difficult position because both China and the US are massive trading partners. Korea exported $132 billion to China and $116 billion to the US in 2025. It cannot afford to alienate either side.
That is a critical point. Korea's export dependence on both the US and China creates what economists call a sandwich risk. Any escalation in US-China tensions forces Korea to choose sides, and choosing either side means losing a $100+ billion export market. That geopolitical premium is embedded in the Korea discount and is unlikely to disappear regardless of governance reforms.
So we have a market with globally dominant companies trading at historic discounts with a government-backed reform program, recovering from a political crisis, and sandwiched between two superpowers. That's a lot of moving pieces. Let's dig into what is actually happening inside Korean tech.
Let's start with the AI story, because Korea's tech giants are making some really aggressive moves. What are Naver and Kakao doing?
Naver and Kakao are both pivoting hard into what the industry calls Agentic AI. This is AI that does not just answer questions, but actually takes actions on your behalf. Think of it as the difference between a chatbot that tells you restaurant recommendations and an AI agent that actually books the restaurant, reserves the table, and adds it to your calendar.
That is a significant upgrade from the current ChatGPT experience.
It is, and Korea is uniquely positioned for this because of how integrated Naver and Kakao are into daily life. Naver is Korea's dominant search engine, shopping platform, and mapping service. Kakao runs Kakao Talk, the messaging app used by virtually every Korean. When these companies deploy AI agents, they have instant access to hundreds of millions of user interactions across search, shopping, messaging, payments, and logistics.
So what specifically are they building?
Naver unveiled Agent N as its core AI strategy. They are rolling out an AI shopping agent in Q1 2026, an AI-integrated search tab in Q2, and a business-focused Agent N for advertisers. Naver has committed over $1 trillion, about $691 million, to GPU and AI infrastructure. They are also building a sovereign AI model for the Korean government alongside LG, SK, NC, and Upstage, which is a direct competitor to Western AI models for Korean language applications.
And Kakao?
Kakao has its own approach. They are developing Kanana, a proprietary on-device AI model that proactively offers assistance based on conversational context inside Kakao Talk. Imagine your Kakao Talk being able to read your messages and proactively suggest actions. Someone texts you about dinner? Kanana suggests restaurants nearby, shows available reservations, and offers to book. The full agent-based Kanana launches in the first half of 2026.
That is going to be incredibly powerful, given that Kakao Talk has near universal adoption in Korea. But here's my question. Can Korean AI models compete globally against OpenAI, Anthropic, and Google?
That is the key question, and the honest answer is probably not globally, but absolutely domestically. Korean language AI is a niche that Western models have not fully optimized for. Korean is a complex language with unique grammar, honorific systems, and contextual nuances. Naver and Kakao have decades of Korean language data that no Western company can match. For Korean language applications, they will likely be superior to GPT or Claude for years to come.
Okay, let me shift to the cultural export story because I think this is one of Korea's most underappreciated economic assets. K-content is absolutely dominating global streaming.
The numbers are remarkable. Korean language content is now the second most consumed content category on Netflix globally, behind only English. Think about that. Korean is not in the top 10 most spoken languages, but it is the #2 content language on the world's largest streaming platform. An Ampere analysis report confirmed that South Korean content is second only to the US in total viewing hours on Netflix.
And the economic spillover effects are huge, right?
Enormous. Research shows that every $100 million in K-content exports stimulates roughly $180 million in exports of consumer goods like cosmetics, fashion, and food. In 2023, Hallyu-driven consumer and tourism exports reached nearly $6.5 billion. Netflix committed $2.5 billion to Korean content production over 4 years. The Korea Creative Content Agency positioned 2026 as the golden age for K-content structural evolution.
And there's a startup angle, too. Korean startups dominated CES 2026, right?
Yes, Korean companies captured 15 of the 31 Best of Innovation Awards at CES 2026, nearly half of all top owners. AI-focused SMEs and startups accounted for 10 awards. Samsung is building an AI factory with over 50,000 NVIDIA GPUs. The Korean government has invested in over 50,000 GPUs through the National AI Computing Center. Korea is building serious AI infrastructure, despite being a fraction of the size of the US or China.
And there's something else interesting happening. Kakao made a strategic move by handing off its legacy portal Daum to Upstage, a Korean AI startup. That's essentially Kakao saying, the old web portal business model is dead. We are going all in on AI native services. It is a bold signal of how seriously Korean tech companies are taking the AI transition.
That Kakao Upstage deal is actually more significant than most people realize. Upstage is one of Korea's most promising AI startups, founded by former Naver engineers. By acquiring Daum's massive user base and content archive, Upstage gets the data it needs to train Korean language AI models, and Kakao gets to shed a legacy business while investing in the AI future. It's a win-win transaction that shows the Korean tech ecosystem is capable of the kind of creative restructuring that the Value Up program is trying to encourage.
And NVIDIA is deeply involved in Korea's AI build-out too.
Yes, NVIDIA has partnered with the Korean government and major industrial companies to build AI infrastructure. Samsung's AI factory with over 50,000 NVIDIA GPUs is one of the largest non-hyperscaler AI computing installations in the world. The Korean government's National AI Computing Center adds another 50,000 GPUs. For a country of 52 million people, Korea is investing in AI infrastructure at a per capita rate that exceeds most Western nations.
So when you add it all up, Korea has a semiconductor superpower in SK Hynix, platform giants going all in on AI, a globally dominant content export machine, a vibrant startup ecosystem, and serious government-backed AI infrastructure. Why is the market still discounted?
Contrarian corner time, Maya. And my contrarian take on Korea is going to challenge the reformists. Here it is. The corporate Value Up program will underperform expectations because Korea's government's problems are structural, not informational. Simply requiring disclosure will not change the behavior of chaebol families, who have controlled these companies for 3 generations.
That is a direct challenge to the bull thesis. Everyone is comparing Korea to Japan and expecting the same results. Why do you think Korea is different?
Japan's corporate governance transformation worked because Japan's problem was cultural inertia, not structural incentives. Japanese companies were sitting on cash because they did not know what else to do with it. There was no controlling family that benefited from low returns. Once the Tokyo Stock Exchange put pressure on, companies were willing to return capital to shareholders because there was no one personally disadvantaged by doing so.
But Korea's chaebols are different because the family founding benefit from the discount.
Exactly. The Korea discount is not a bug, it is a feature for the controlling families. When Samsung trades at a low price-to-book ratio, it is easier for the Lee family to maintain control through circular shareholdings and below-market transactions. If Samsung traded at its intrinsic value, the cost of maintaining family control would be astronomical. The families have a direct financial incentive to keep valuations low. Disclosure requirements do not change that incentive structure.
That is a really cynical reading. But is there evidence?
Look at the data. Korea first tried governance reforms in 2015, then again in 2018. Each time, there was a brief rally in undervalued stocks, followed by a return to the status quo. The reforms failed because they addressed symptoms rather than causes. The current Value Up program is better designed than previous attempts, but it still relies on voluntary compliance and social pressure rather than enforcement mechanisms with real teeth.
But the Japanese comparison is powerful. Investors made enormous returns betting on Japan's governance reform. Are you saying the same trade will not work in Korea?
I am saying it will work less well and more slowly than people expect. Japan's reforms took about 3 years to significantly move valuations. Korea's will take longer because the resistance is structural. In Japan, companies buying back shares was a neutral act for management. In Korea, it dilutes family control. Every buyback, every dividend increase, every cross-shareholding unwind is a direct threat to the chaebol families. They will resist, delay, and find workarounds.
Okay, but let me push back. The political environment has changed. The martial law crisis exposed the fragility of the old system, and there is genuine public anger at the chaebols. And international investors are demanding reforms as a condition for investing. Is that not enough pressure?
It creates the appearance of reform without necessarily delivering the substance. Here is what I expect. The most visible, internationally watched companies like Samsung Electronics and SK Hynix will make genuine governance improvements because they need global capital markets. But the hundreds of mid-cap and small-cap chaebol affiliates, the companies that actually make up 69% of the below-book KOSPI, will pay lip service to Value Up while changing very little. The discount narrows at the top and persists at the bottom.
So a bifurcated outcome. Blue-chip Korea reforms, mid-cap Korea stay stuck.
That is my base case. And there is one more risk I want to flag. The one. Despite a 60% equity market return in 2025, the won remains weak at 1470 to the dollar. ING noted in their 2026 outlook that economists see no Bank of Korea rate cut in 2026 amid concerns about the weak won in housing. The won weakness reflects structural issues, including Korea's aging population, heavy dependence on semiconductor exports for trade surplus, and geopolitical risk from North Korea. A weak currency amplifies the Korea discount because foreign investors lose on the currency even when stocks go up, exactly the same dynamic we discussed with Japan's yen.
So the currency is eating into returns even for stocks that do reform?
Precisely. If the won depreciates 5% while Korean stocks rise 10%, the dollar-denominated return is only 5%. Global investors compare that to US stocks and say, why bother with the governance risk and currency risk for a mediocre return? That is the Korea trap. Great companies, persistent discount, weak currency. Breaking out of it requires not just governance reform, but currency stability, which requires macroeconomic credibility, which requires political stability, which Korea has struggled to maintain.
All right, Maya, 3 action items.
Number 1.
Number 1, play Korea selectively through globally competitive exporters rather than the broad index. The Korea discount means the broad KOSPI index looks cheap, and it is cheap, but cheap can stay cheap for a long time when the governance headwinds are structural. Instead of buying the whole index, focus on the companies that are genuinely reforming and have global competitive advantages that do not depend on domestic governance fixing itself. SK Hynix is the clearest example. Dominant in HBM memory chips that every AI data center needs, actively improving shareholder returns, and trading at a meaningful discount to comparable companies like Micron. Samsung Electronics has issues. Its foundry business is struggling, as we covered in a previous episode, but its memory and display businesses remain world-class. Naver is interesting as an AI play because its domestic data advantage creates a competitive moat that Western AI companies cannot easily breach. Pick the winners rather than betting on the index to re-rate.
Selective Korea rather than broad Korea. That makes sense given the bifurcated reform outlook. Number 2.
Number 2, treat K-content as an emerging asset class, not just entertainment. The cultural export machine is generating $6.5 billion in annual spillover revenues, and that number is growing at double digits. Netflix's $2.5 billion commitment to Korean content is just the beginning. Amazon, Apple, Disney, and HBO are all increasing Korean content investment. For investors, the play is not just entertainment companies. It is the entire Hallyu ecosystem. Korean cosmetic companies like Amore Pacific, food exporters riding the K-food wave, and tourism infrastructure companies benefiting from Hallyu-driven tourism. The Korea Creative Content Agency calls 2026 the golden age of K-content. If that is even half right, the spillover into consumer goods, tourism, and services could add a full percentage point to Korea's GDP growth over the next 5 years.
K-content as an investment thesis. I had not thought of it that way, but the multiplier effects are genuinely significant. And number 3?
Number 3, monitor the won as your primary risk gauge for all Korean investments. The won at 1470 to the dollar is both a risk and an opportunity. If the currency stabilizes and appreciates toward the 1300 range, which ING suggests is possible as the US-Korea interest rate differential narrows, then Korean equities get a double boost, improving fundamentals plus currency tailwind. But if the won weakens further past 1500, governance reform and export strength may not be enough to deliver positive dollar-denominated returns. The won is the gate variable for Korea. If it stabilizes, everything else works. If it does not, even great companies deliver mediocre returns for foreign investors. Watch the Bank of Korea's rate decisions and the USD/KRW pair as your primary Korea indicators.
The won as the gate variable. That is a really useful framework for thinking about Korea exposure.
And here's the takeaway I want everyone to remember. Korea is the most paradoxical economy in Asia. It has world-class companies, a dominant cultural export machine, cutting-edge AI development, and the world's most advanced memory chip maker. And yet, almost 70% of its stock market trades below book value. That paradox is the Korea discount, and it has persisted for decades. The Value Up program is the most serious attempt to fix it. But fixing a problem that benefits the people who control the companies is fundamentally harder than fixing one where everyone's interests are aligned. Korea is not Japan. The discount will narrow, but it will not disappear. And for investors, that means Korea is a stock picker's market, not an index market.
And I want to add one more observation about why Korea matters so much right now for global investors. Korea is essentially a barometer for 3 of the biggest themes in global markets: AI infrastructure through SK Hynix in the semiconductor sector, the creator economy through K-content exports, and emerging market governance reform through the Value Up program. If Korea can successfully close the governance gap, stabilize its currency, and capitalize on AI and cultural exports simultaneously, it becomes one of the most compelling investment destinations in the world. If it cannot, it remains the frustrating almost market that has disappointed global investors for decades. I think 2026 and 2027 will tell us which path Korea takes.
And that uncertainty itself creates opportunity. When the outcome is binary and the market is priced for the bearish scenario, the risk-reward for the bullish outcome is asymmetrically favorable. The key is sizing your position appropriately and being selective about which Korean assets you own.
And coming up next, we are diving into the quantum computing race in Asia, Japan's Recon Lab, China's Origin Quantum, and Korea's own massive quantum research budget. Is quantum the next frontier for Asian technology leadership, or is it the most overhyped technology since blockchain? We'll break it all down. Thanks everyone for listening.
Stay data-driven. Bye.